Imagine waking up tomorrow to a world where the financial system still looks normal on the surface. ATMs still work. Stock markets still open. Governments still issue statements about stability. Banks still tell depositors their money is safe. The language of confidence remains everywhere. And yet beneath that calm surface, one fact has already become inescapable. The world owes more than it can realistically repay. Not one country, not one corporation, not one over-leveraged sector, the world. Governments owe amounts so large they can no longer be understood as temporary emergency burdens. Corporations borrowed for buybacks, acquisitions, real estate expansion, and survival. Households piled into mortgages, student loans, credit cards, and consumer debt just to preserve living standards in an age of rising costs. Entire economic systems became dependent on the assumption that debt could always be rolled forward, refinanced, inflated away, or rescued by central banks before the reckoning arrived. For decades, that strategy seemed to work. Every crisis was met with lower interest rates, more liquidity, larger deficits, and new promises that growth would eventually outpace the debt mountain. When markets cracked, money got cheaper. When banks froze, central banks intervened. When economies stalled, governments borrowed more. When the system weakened, policymakers did not reduce dependence on debt. They deepened it. And that is how debt stopped being a tool and became the operating system of modern civilization. This is what makes the current moment so dangerous. Debt is not just a number on a spreadsheet. It is a claim on future income, future taxes, future labor, future productivity, and future political stability. It is tomorrow being spent to preserve today. And when an entire world does this at once, the result is not simply financial fragility, it is a civilization-wide trap. Because there are only so many ways the debt endgame can unfold. You can repay it through real growth, but that requires economic expansion strong enough to outrun compounding obligations. You can reduce it through austerity, but that crushes societies already under pressure. You can inflate it away, but that destroys purchasing power and public trust. You can default, restructure, or repress the system financially, but each path carries political and geopolitical consequences. None are clean. None are painless. All of them redistribute suffering. This is why global debt is no longer just an economic story. It is a story about power, about empires trying to preserve dominance through borrowing, about voters demanding benefits without visible sacrifice, about markets addicted to cheap money, about central banks trapped between inflation and collapse, about younger generations inheriting obligations they did not create, about a world that kept solving short-term pain by writing larger claims against the future. And now the bill is coming due. This is the story of how global debt became the biggest time bomb on Earth, how governments, banks, corporations, and households built an economic order that can no longer survive without constant refinancing, how low rates created the illusion of sustainability, how inflation, geopolitics, and slowing growth turned that illusion into a threat, and why the final phase of the debt supercycle may not look like one dramatic explosion, but like a long era of monetary distortion, political crisis, and declining trust in the promises that hold modern society together. 1. How the world learned to live on borrowed time. Debt did not become a global time bomb overnight. It became one because the modern world discovered that borrowing could delay consequences with astonishing effectiveness. In its healthy form, debt is productive. A business borrows to expand output. A government borrows to build infrastructure. A household borrows to buy a home or invest in education. Credit, in principle, allows societies to bring future productivity into the present. It can accelerate growth, raise living standards, and smooth out shocks. Used carefully, debt is not a weakness. It is one of the most powerful tools in economic life. But the logic changes when debt grows faster than the productive capacity needed to service it. That is when credit stops financing tomorrow's wealth and starts cannibalizing it. New borrowing no longer creates enough real value to justify the obligations attached to it. Instead, it props up old promises, old asset prices, old lifestyles, and old political arrangements. Growth becomes increasingly dependent on larger doses of leverage just to maintain momentum. The system still moves, but it moves less because it is strong and more because it cannot tolerate stopping. That is the turning point the world crossed years ago. Governments borrowed because democratic societies found it easier to promise than to cut. Welfare states expanded. Militaries remained expensive. Aging populations demanded pensions and health care. Tax systems became politically hard to reform. Every recession triggered stimulus. Every emergency triggered another wave of spending. Leaders discovered that borrowing could postpone political pain, and once that lesson was learned, it became nearly impossible to reverse. Corporations borrowed because cheap money made leverage irresistible. Why rely on slow organic growth when you could refinance endlessly, acquire rivals, buy back shares, inflate valuations, and reward investors faster through debt-fueled engineering? Low interest rates did not merely support productive investment, they rewired incentives across the corporate world. Debt became a strategic advantage. Households borrowed because wages stagnated, while housing, education, healthcare, and daily life became more expensive. Credit stepped in where income no longer kept pace. Mortgages expanded. Student debt ballooned. Credit cards filled the gap between expectations and reality. Consumption was preserved, but increasingly through claims on future income rather than present prosperity. And above all this stood central banks, quietly becoming the guardians of the debt age. Each time the financial system trembled, central banks lowered rates, expanded balance sheets, stabilized markets, and signaled that systemic collapse would not be allowed. This was not irrational. In many moments, it probably prevented catastrophe, but it also created a deeper condition: the growing belief that debt no longer had the same consequences it once did, that refinancing would always be available, that liquidity would always return, that the system would always be rescued because it had become too interconnected to fail honestly. This belief changed behavior everywhere. Investors took more risk because they assumed central banks would intervene. Governments spent more because they assumed rates would remain manageable. Corporations levered up because money was cheap. Households bought assets at inflated prices because financing costs stayed low. The entire world adjusted itself to an era in which debt service mattered less than access to the next round of refinancing. The result was historic. The global economy did not merely accumulate debt, it reorganized itself around continuous rollover. In that kind of world, the true danger is not the existence of debt alone. It is dependency on the conditions that make debt appear sustainable. And those conditions do not last forever. 2. The great illusion of cheap money. For years, the debt mountain looked manageable for one simple reason: interest rates stayed extraordinarily low. This hid the scale of the danger. A government can carry enormous debt if its financing costs remain suppressed. A corporation can service massive liabilities if refinancing stays easy. A housing market can tolerate extreme prices if monthly payments remain barely affordable under low-rate conditions. In each case, the system appears stable, not because the debt burden is small, but because the cost of carrying it is temporarily muted. That distinction is everything. Low rates created one of the greatest illusions in financial history. They made insolvency look like liquidity. They made structural weakness look like policy success. They made inflated asset values look justified. They made debt-dependent growth look normal. And because this illusion lasted for so long, an entire generation of policymakers, investors, Executives and households began to mistake abnormal monetary conditions for the natural state of the world. Money was supposed to have a price. Interest rates were supposed to signal risk, scarcity, and the time value of capital. But when rates are pushed down across the system for years, those signals blur. Weak firms survive longer than they should. Governments delay reforms they should have made. Investors chase yield into riskier corners of the market. Property becomes unaffordable, but still rises because financing stays accessible. Debt expands not because the future has become more productive, but because carrying the burden seems painless. This is how financial systems rot without looking broken. The danger is not just that people borrow too much. It is that low rates distort judgment. They encourage the belief that any liability is sustainable if the monthly cost remains tolerable. But debt is never only about the present payment. It is about exposure to a changing conditions. A structure that survives only under ultra-cheap money is not stable. It is fragile by design. And then the environment changed. Inflation returned. Supply chains fractured. Geopolitics hardened. Energy shocks rippled through economies. Central banks faced a problem they could not ignore. Keep money too cheap, and inflation risks escaping control. Raise rates, and the debt-based order begins to crack. That is the bind at the heart of the debt endgame. The world spent decades building an economy that needed low rates, then entered an era where low rates became harder to justify. That single shift transformed the meaning of the debt mountain. Obligations that looked manageable at near-zero rates began to look dangerous once money had a real cost again. Refinancing became more expensive. Interest burdens rose. Governments felt budget pressure. Real estate weakened. Corporate defaults became more plausible. Zombie firms faced a harsher world. The illusion began to break. And once markets realize a system is not merely indebted, but rate-sensitive at every level, panic can spread in subtle ways long before it becomes visible in headlines. Banks tighten standards. Consumers pull back. Governments face harder trade-offs. Credit spreads widen. Investors demand higher returns. Confidence thins out. The debt itself has not changed, but the regime around it has. That is often how the endgame begins. 3. When sovereign debt stops looking risk-free. For a long time, the most dangerous debt was assumed to be private debt. Risky mortgages, over-leveraged corporations, fragile banks, emerging market crises. These were the places where panic was supposed to start. But the deeper threat now sits closer to the center of the system: sovereign debt. This is what makes the present era different. Governments are not merely responding to debt crises anymore. They are increasingly becoming the debt crisis. Modern states have promised more than their tax bases can comfortably sustain. Pensions, healthcare systems, defense commitments, industrial policy, social transfers, infrastructure renewal, disaster response, demographic support, interest payments, and crisis management all compete for resources at the same time. In theory, wealthy governments can always borrow because they can tax, issue currency, and command credibility. In practice, that credibility depends on markets believing the state remains governable, productive, and politically capable of making hard decisions. That belief is now weakening in many parts of the world. The problem is not simply that debt to GDP ratios are high. It is that the political systems carrying those burdens are aging, polarized, slower moving, and increasingly unable to deliver either fiscal discipline or rapid growth. Debt becomes truly dangerous when a nation loses the ability to convince investors that tomorrow will be more manageable than today. And sovereign debt crises are uniquely destabilizing because government bonds sit at the foundation of the financial system. Banks hold them. Pension funds hold them. Insurers hold them. Central banks hold them. They are used as collateral, as reserves, as supposedly safe assets around which the entire structure of finance is built. When trust in sovereign debt weakens, it does not stay contained. it spreads outward into the plumbing of everything else. This is the nightmare scenario policymakers fear most. Not just defaults, but loss of confidence in the instruments that underpin the system's idea of safety. Once that happens, governments face brutal options. They can cut spending and raise taxes, but that risks recession, public anger, and political revolt. They can borrow more, but that may push yields even higher if markets start demanding compensation for risk. They can pressure central banks to monetize debt more aggressively, but that risks inflation and currency weakness. They can repress the system financially by forcing domestic institutions to absorb more government paper, but that quietly transfers the burden onto savers and pensioners. None of these choices restore normality. They merely determine who absorbs the pain. And this is why sovereign debt is the true core of the endgame. A household can default, a company can go bankrupt, even a bank can be merged, rescued, or resolved. But when the state itself becomes overextended, the crisis moves from finance into legitimacy. Then the question is no longer just whether liabilities can be serviced, it is whether the political order can survive the methods required to service them. That is when debt becomes something larger than economics. It becomes a test of social cohesion. 4. The hidden war between inflation and default. At the deepest level, the debt endgame is a conflict between two unacceptable outcomes: inflation and default. No government wants to say this openly because modern financial systems run on confidence. But when debt becomes too large relative to real productive growth, someone must take a loss. There is no magical escape. The only question is how that loss is distributed and disguised. Default is the honest version. It says the promises cannot be kept in full. Creditors must accept less. Assets are repriced. Some institutions fail. Pain is immediate and visible. Inflation is the quieter version. It does not tear up the contract outright. It preserves the nominal promise while hollowing out its real value. Creditors are repaid in money worth less than expected. Savers lose purchasing power. Wage earners fall behind. The burden is spread more diffusely across society. Politically, this is often easier to tolerate at first because it feels less like a decision and more like a condition. That is why inflation has historically been one of the most seductive ways to deal with excessive debt. It allows governments to reduce the real weight of obligations without formally admitting failure. But inflation is not a free solution. It destabilizes expectations. It erodes trust in institutions. It distorts investment. It punishes those with cash savings and fixed incomes. It turns everyday life into a constant repricing exercise. And once people begin to expect inflation as a policy habit rather than a temporary episode, the damage becomes harder to control. So policymakers try to walk a narrow line. Enough inflation to ease debt burdens. Enough restraint to preserve credibility. Enough support to keep markets functioning. Enough tightening to prevent a currency crisis. Enough growth to calm politics. Enough sacrifice to look responsible. Enough avoidance to stay in power. This is not a stable balancing act. It is a slow-motion confrontation with arithmetic. And the world's major powers are all trapped in different versions of it. Some countries fear inflation more because their currencies are fragile. Some fear deflation and stagnation more because growth has already weakened. Some fear social unrest more than either. Some still believe technological progress or productivity gains will rescue them. Others are betting that financial repression, industrial policy, capital controls, and central bank coordination can keep the structure intact for decades. Maybe in some places it can, but globally the pattern is clear. The debt burden is too large to disappear naturally, too politically entrenched to be reduced cleanly, and too systemically important to be allowed a sudden collapse. So the endgame becomes an extended struggle over who pays. Not just creditors or debtors, entire generations, entire classes, entire nations. And that is why the debt crisis of the future may not arrive like a single apocalyptic crash. It may unfold as a drawn-out era in which currencies weaken, living standards compress, politics radicalize, taxes rise, asset bubbles recur, bailouts multiply, and trust slowly bleeds out of the institutions that promise stability. The bomb does not need to explode all at once to remake the world. Sometimes it is enough for it to keep ticking in every balance sheet, every budget, every mortgage payment, every bond auction, and every election. If you want, I can continue with parts 6 to 10 in the same style and turn this into a full 20 to 30-minute YouTube script.